is Kairunisa Natasha binti Muhammad Nazri. I am from class D1AC 1105C, and I am going to present about introduction of our assignment, background for our company, which is Scanwolf Corporation Berhad, and the last one is conclusion based on from our overall finding. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Syahmi Firdaus bin Sudirman. I'm from group D1AC 1105C. I'm going to present to you about liquidity ratio and leverage ratio from Scanwolf Corporation Berhad.
Hai, Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Nadira binti Alman. I'm from D1AC 1105C. I'm going to present profitability ratio of Scanwolf Corporation Berhad.
We discuss about introduction, background, and financial ratio analysis for Scanwolf Corporation Berhad. We will continue to discuss about common size ratio and trend analysis for Scanwolf Corporation Berhad for 2019 and 2018. I'm Siti Nursyahada binti Talib from AC1105C class. We will present about common size ratio and trend analysis for Scanwolf Corporation Berhad.
Introduction. For financial statement analysis, group project financial ratio analysis, we have selected Scanwolf Corporation Berhad as the main company for our group project. We also choose Sapura Industrial Berhad as the company to make the comparison. Next, as much appreciation and thanks to Madam Siti Nur Azmawati for guiding us a lot throughout the process of completing this project group. Financial analysis is an assessment of the capability, stability, and profitability of a business or company. It is done by professionals such as accountants who provide reports using ratios, as well as other techniques which use information taken from the financial statement of companies such as SOPL, SOFP, and others. These reports are often presented to superior as one of the means or medium in making decisions in business. Among them is to continue or to stop the main operation or part of the business only. Financial ratios is a material or tool that is useful in helping investors, banks, business managers, and shareholders to compare the relationship between finance between account and also the parallelism in the financial statement of companies. It provides a better understanding of the company's performance than do raw numbers. Financial ratios can also show how a company has performed in the past and also how the company might perform in the future. There are several types of financial ratios that will be discussed and calculated in this assignment. Types of ratios that will be calculated is liquidity ratios, which consists of current ratio and acid test ratio. Next, leverage ratios comprise of debt ratio, debt to equity ratio, and time interest earned. Last, profitability ratios that include gross profit margin, operating profit margin, return of asset, and also return on equity. Last but not least, we also discuss about common size ratios, which when attempting to get a better understanding of an organization, common size ratio can be very helpful. Common size ratios also are most effective when compared to different companies working in the same region. Last, if we want to compare over a certain time span, common size ratio are also very useful. Background. Scanwolf Corporation Berhad and its subsidiaries are engaged in the manufacture of extrusion materials in the plastic fields around Malaysia. Scanwolf was listed on 16 July 2007 on the second board of Bursa Malaysia Securities Berhad and was subsequently listed on 16 July 2007. On 3 August 2009, Scanwolf Corporation Berhad relocated to the main board. In March 2012, Scanwolf diversified its business into property production. In Tronoh, Perak, Scanwolf has a plastic extrusion manufacturing plant and a warehouse in Shah Alam, Selangor. For the financial year ended FYE 2017, 39%, 2016, 41% of the manufacturing division revenue was contributed by export sale. The group's key goals and strategies is to continuously develop the manufacturing process and product differentiation in order to increase the amount of business in both local and overseas markets will become the industry leader and the preferred brand. Scanwolf Plastic Industries Sdn Bhd, Scanwolf wholly owned subsidiaries, invested in a joint venture on 2 December 2016 with Nisha Malaysia Industrial and Trading Sdn Bhd, a wholly owned subsidiary of Nisha Printing Co., which is listed in Tokyo Ltd, to manufacture a plastic-related goods, in particular the manufacture of luxury vinyl tiles (LVT), including products related to LVT products, and construction material associated with calendar molding and its related products.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Syahmi Firdaus. Today, I'm going to present to you liquidity ratios. So we're going to talk about current ratio and acid test ratio. First of all, we're going to go through current ratio. Current ratio formula is current assets divided by current liabilities. This is to show that how much money of the current assets to cover their current liabilities. Okay, we go through the calculation first. Scanwolf company shows that 0.97 times of the current ratio, while the industry average, which is resulted 1.57 times. Okay, from this we know that Scanwolf company only have 97 cents of their current assets to cover their RM1 ringgit of current liabilities, as compared to the industry average current assets with RM1 ringgit 57 cents to cover up their current liabilities of RM1 ringgit. This is show that industry average is much better than the Scanwolf company. The reason why Scanwolf company facing this problem is because they facing a poor debt collection system and poor cash management. To improve the Scanwolf company current ratio is to promote their cash sales. Okay, now we move to acid test ratio. Scanwolf acid test ratio is under industry average, which is Scanwolf with 0.11 times and industry average 1.103 times. This is to show that this average is to show that how much the company current asset without their inventory and prepaid expenses to cover their current liabilities. Okay, the performance of the Scanwolf company based on acid ratio test is poor because the acid test ratio of Scanwolf company is under 0. This is resulted to the company will not be able to pay its immediate obligations and therefore should be looked at with cautious. The reason why this is happening because the prepaid expenses occurred by the Scanwolf company might be too much for the company to handle. Okay, to fix the problem of the Scanwolf company about this ratio is they must focus on promoting cash sales, which is the company will be selling goods and cash basis, and discounts will be given to encourage the cash sales. Next, we're gonna look at leverage ratios, which is I'm gonna present about debt ratio, debt to equity ratio, and time interest earned. Okay, first of all, debt ratio. What is debt ratio? It is a ratio to measure the percentage of the company finance their assets using debt. Okay, Scanwolf company is financing their asset by 68.55% and the remaining with equity, compared to industry average, which is financing their assets using the debt by 48.89% and the remaining is financed by equity. This shows that Scanwolf company's performance is poor because 68.55% of total asset is financed by the debt. This is show that the company is too much depends on debt, which is really make them the company took really high risk to perform their business. The cause of this situation because the company is leaving less retained profits for expansion purposes. To avoid this problem is by financing capital investment from an issue of shares to cover up the debt they might be facing right now. By issue the share, they can get the money from the shares that they obtain. Now we're gonna look at debt to equity ratio. Debt to equity ratio measures between the debt and equity. Is it the company finance the company using debt or the equity more? Okay, we're gonna look at the Scanwolf company, which is with 217.93% of debt to equity ratio, while the industry average 95.64%. Okay, the performance of the Scanwolf company could say that the Scanwolf company is unsatisfactory compared to industry average, which is show the double of industry average. It is very resulted to bad reputation of the company. The debt to equity ratio of Scanwolf company with 217.93% shows that the company is using 217.93% debt more than the equity. This is happened because the company's high dividend payout ratio that caused the company facing high amount of debt. The recommendation for the Scanwolf company to fix this problem is by the company should have an optimum mixture of sources of financing. Okay, now we move to time interest earned, which is Scanwolf company shows the result of 0 times interest earned compared to industry average 2.939 times. This average going to show how much earnings to finance their interest expenses. From the ratio that we get from the calculation of times interest earned, show that the Scanwolf company did not have ability to cover their interest charges or interest expenses using operating revenue, because this formula this formula using earning before interest and tax, which is operating revenue. From the operating revenue, the scanwolf company cannot finance their interest expenses. So, the reason why this situation happened is because the company had to face, which is result to the company performance is bad. The company might facing losses in a big amount, so they don't get any earnings from their operating revenue. So they end up cannot finance their interest expense using their operating revenues. So the suggestion for scanwolf company to overcome this problem is by the company should not take additional debt financing if it's already too highly leveraged. They should avoid additional debt since they already in pretty highly leveraged because of the debt they facing right now. That's all for me. Thank you.
Hi, Assalamualaikum. My name is Nurul Nadira binti Arman. So let's continue with my part. Next, we move to the profitability ratios. Every firm is most concerned with its profitability. The profitability ratios is one of the financial ratios analysis that frequently used by companies in determining the company performances. Either the company is as profitable as other companies. The profitability ratio measures the effectiveness of the firm uses its assets in making profits. It also indicates the efficiency of the firm in controlling costs and its pricing policies. In this project, we are going to calculate 5 profitability ratios, which is gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Gross profit margin is to show the company in controlling its cost of goods sold as how much gross profit that the company can earn by sale made. The calculation shows that the scanwolf company's ratios is 0. We can say that the company's ratios is lower than the industry average, which the industry average is 14.72%. The scanwolf Corporation Berhad is not a retail company, therefore there is no any gross profit of the company, and it is mean that gross profit margin ratio is not applicable to the company. It will not affect the company performances even though the company is below the industry average. The second one is operating profit margin. Operating profit margin is a profit that earned from the operation of the company. Scanwolf company is under the industry average as the company is having a ratio of 0% compared to the industry average that having much better than the company, which is 3.29%. Due to the company is incurring higher operating expenses, the company performances is bad. So, in order to fix the company performances, The company should reduce the operating expenses. As example, scanwolf company need to change their supplier that supply raw materials to the company with other supplier that offers more affordable price. The higher the operating expenses, the lower operating profit margin. The third one is net profit margin. Mm, from the calculation that shows in the slide, uh, this ratio is 0% and below the industry average that shows the ratio of 1.81%, resulting the company's performance is poor. Since the company was having too much operating expenses, it has led to lower net profit. However, in this case, high use of debt financing is the cause of the scanwolf company experience lower net profit margin as the finance cost is deducted before arriving to net profit. The company has to pay higher finance costs compared to receive finance income more. The suggestion to the company to fix this lower net profit margin is the company should not take any other additional debt financing. Fourth is return on asset. Return on asset is also can be called as return on investment. This ratio is ability of the management to earn profits from the investment of the company. From the calculation, Scanwolf return on asset is slightly lower than the industry average as the company resulted of 0% compared to the industry average 2.02%. The performances of the company is bad. This is because the company is having too much property, plant and equipment that cause expenditures rapidly increases. In order to overcome this problem, Scanwolf company need to increase revenue without increasing asset costs. So, as example, improve the customer service and reduce in purchasing assets. Last but not least, we move to the return on equity. Return on equity occurs to measure the ability of the company in giving profits to common stockholders as return from their investment in the company. The calculation shows the company is having 0% ratio. Meanwhile, industry average is having 3.88% return on equity ratios. Scanwolf company is doing a bad performance in using the investors' money and fail to give profit to them and company lacks of investor. So this might be the reasons that the company is facing lower return on equity. The recommendation that can be given to fix the company's problem is improve net profit margin. The higher net profit margin, the higher return on equity ratio. Other than that, Scanwolf company should manage idle cash. It will help to reduce equity since the company by pay off the debt and subsequently will reduce the interest expenses.
Now, let's move to the last part of the financial ratio analysis of the Scanwolf Incorporation Berhad, which is common size ratio. Before I explain more about the analysis of the common size ratio from the company financial statement and the trend for 2019 and 2018, let me explain about common size ratio. Common size ratio is useful technique that can used to assess business performance or the company financial performance for business owner or financial manager. It is also known as vertical analysis. As we know, common size ratio is not only simple, but it is a useful technique to assess business performance. To calculate common size ratio from statement of financial position, each category of asset are calculated as a percentage of total assets, and each item of liability as percentage of accumulated liabilities and owner equity, which is actually also same amount with total assets. The purpose or objective of preparing this common size ratio is to possibilities of changes occur or what to do in the response. I also already compiled with statement of financial position of the scanwolf Incorporation Berhad for 2019 and 2018. Now let's take a look to the scanwolf Corporation Berhad common size statement of financial position trend analysis. So, this is the common size statement of financial position of the scanwolf company that I made to see the trend in the company's performance for 2019 and 2018. So, as we made the common size ratio and a financial statement, we can see the trend in this company. There is increases and decreases and also unchanged in the trend of the company performance. In non-current asset, we can see that the trend of property, plant and equipment for 2018 and 2019 is increased from 23.9 to 24.9%. For investment in an associate, we can see that the trend is decreased from 0.1% to 0. For deferred tax asset, we can see that the trend is slightly increased from 1.1% to 1.3%. In inventory, we can see that it is increased from 8.5% to 8.9%. And lastly, for other receivable, we also can see that the trend is increased from 4.1% to 9.8%. Next, in non-current liability, we can see that other payable and borrowing is decreased, and higher purchase liability, we can see that the trend is increased, and in deferred tax asset, it remain unchanged in percentage. Now I will explain more about the trend analysis of the performance for the company from 2018 to 2019. As for property, plant and equipment, percentage of property, plant and equipment is increased from 23.9% to 24.9% of total asset, which means it is increased by 1%. The possibility percentage of property, plant and equipment increased because of purchase of new property, plant and equipment amounted to 1679276, and also I can assume that it is increased because of the proceed from disposal of plant and equipment consists of 5,999. For investment in an associate, we can see that the percentage is dropped from 0.1% to 0. It is decreased to 0 because of share in post-acquisition loss of associate. This performance is unsatisfactory performance. The unquoted share at cost for investment in an associate for the year 2019 is 872,500, and the share in post-acquisition loss of the associate is also the same amount, and it is cost no carry amount presenting share of net asset for the year 2019, which means the investment in an associate is written down. Investment in an associate, it is an ownership interest that have percentage of interest between 20% to 50%. Now let's move to deferred tax asset. The percentage of deferred tax asset from 2018 to 2019 is slightly increased from 1.1% to 1.2%. The percentage of deferred tax asset increased by 0.2% because of overpayment of the income tax paid in advance to an associate. The increase in the percentage of deferred tax is good because the company possibly can receive a future tax benefit from this deferred tax asset. It is because is the company deferred tax is higher than other year. It means that the company could pay less tax in future. It is also good because the investor will look into deferred tax asset because they will identify this company whether the company could pay low tax rate in the future year. But for this company, no portion of deferred tax asset has been recognized because it is not probable that taxable profit will be available in the foreseeable future to utilize the benefit. As for inventory, the trend of the inventory is increased by 0.4%. The possibilities on the change occur because of the properties held for the sale is higher than 2018. This increases in the percentage is unsatisfactory because it is mean the inventory cannot expected convert into cash or held for sale within the year, and the company may be hold too much inventory. That is the large portion of all inventory may consist of obsolete and old. This also can show the investor whether the company have a proper inventory control system due to poor management or not. In this situation, the company should improve and evaluate the inventory control system. In the last portion of non-current asset, the trend of other receivable is show an increase in the percentage by 2.7%. This performance is good and satisfactory. The possibilities on the change occur is because increase in amount due from an associate receive. The company received the current portion of the amount due to investment in an associate later than 5 years amounted to 593,953 ringgit. And for other payable, the trend of the other payable from 2018 to 2019 is decreased by 0.2%, and it is unsatisfactory performance. And this decrease possibly occurred because the company may be paying the debt on its period debt at faster rate, or buy the item or inventory in cash rather than purchasing it on credit, and it will decrease the cash of the company. For hire purchase liabilities, the trend of hire purchase liability increased by 0.2% of total liabilities and owner equity. This increase of the hire purchase liability is satisfactory and good. The possibility of the change occur is because the increases in total outstanding of higher purchase liability and decrease in weighted average effective interest rate of higher purchase obligation from 9.67% in 2018 to 9.56% in 2019. In higher purchase liability, the company will extend the time period of paying. Normally, the higher purchase liability is made to buy the item that is expensive that the company cannot afford to buy it in cash. So, the company will purchase it with higher purchase liability. And for borrowing, the trend in borrowings is decreased by 3.8%. This possibly because of the decrease in fixed deposit pledge amounted to 723,141 and also proceed from bankers acceptance and term loans. And as for deferred tax asset, the trend of the deferred tax asset liability is remain unchanged, which is in 1.4%.
Conclusion: financial analysis measures the health and stability of a company, offering an understanding of how the business performs its business. We find that Scanwolf Corporation Berhad is not profitable because the company makes losses and has no revenues. Based on extensive analysis, Scanwolf will also not be able to pay their bills because the amount of debt is higher or less than equity relative to equity that would demonstrate the company's success by showing the debt. Next, the company shows how low liquidity in 2019 based on results between 2018 and 2019 because when there is a percentage rise, it is not good because it indicates that inventories may not be expected to be converted into cash or kept for sales during the year because the company may keep a lot of inventory that may consist of obsolete and old. In addition, Scanwolf Corporation is still not in the industry benchmarks because by looking at the percentage that have been reached, such as the operating profit margin, Scanwolf Corporation is below the industry average because the company has an operating profit margin ratio of 0% relative to the industry average. The company's return on equity also has a weak ratio because the company has a 0% ratio, while the market average has a return on equity ratio of 3.88%. The Scanwolf business is doing a terrible job. Therefore, Scanwolf Corporation Berhad must do something drastic to boost the company in line with the other companies that are equal to or more than the normal ratio industries.